Welcome back, everyone. It is time for another red hot covered call video. I have some stories to tell you this week. It has been a very exciting week. The stock market is doing its turbulent rock and roll, and I have been riding that wave up and down. I find myself in a good spot with some stocks and in a very bad spot with other stocks. We're going to talk about that today. But as I was sitting back putting together a video for this week, I'm looking at my inbox, and a lot of you have found yourself in a bad spot where you bought a stock, you made the right decision, but at the end of the day, that stock has fallen, and now trying to write those covered calls above your purchase price is tough, and I get it. So we're going to talk today about what we can do selling premium in these very volatile times with the stock market. Hey, look, before we get going, if you like what we're doing here at the channel, I want you to subscribe to the channel. And hey, look, man, if you like this video, bang that like button. It lets me know you like what I'm doing. A lot of you cats ask me, hey, look, how you doing in the stock market now? Well, all I can tell you is, to this point, 3 months into the year, I'm already over 15,000. That number, if you go to ctpdashboard.com, you can always see where I'm at month over month because I post it right there. Now, as with everything, I usually have a plan. Whether it's if I buy a stock, I'm going to write a covered call, I have an exit strategy. I have all these plans in my head before I execute on the plan. So I'm not just going to willy-nilly buy something. Look, I may not make all the best trades, or sometimes my stock purchases might be a little suspect, but I really do have a plan. Now, I don't put them on paper, but I do know how I'm going to execute that trade. And even with my dog, CVS, which I'm down close to $10 on, I do have a strategy. Now, right now, it's not writing covered calls, but I have a strategy, and I'm going to work the strategy. The important thing here is to have a plan, because I also get those emails in the inbox where, hey, look, I bought so-and-so stock on a recommendation, and now I don't know what to do. I don't know anything about the company. So we need to have a plan. We need to execute the plan, because when the stock market eventually turns green, right, we have to believe it's going to turn green if we're going to be in this game. You want to own the stocks that are going to turn green, the ones that Wall Street will buy up. I have a short list of those stocks that Wall Street usually buys up. For example, Adobe, Microsoft, Nvidia, all those stocks that they sell off heavy because they made all the big profits, they eventually buy them back. Now, I'm not recommending any of those stocks, but you have to be watching this stuff so when you make that next purchase, you sort of have a feel for what Wall Street's going to buy up. Let's talk about selling premium in this very volatile market. Well, I find myself in a spot with a couple of my stocks where my purchase price of the stock is higher than where the stock's at considerably. So I need to have a plan. So let's talk about what I can do selling premium in these markets. And number one, depending on my purchase price, I can still write a covered call. I bought Chevron at about 113 and it's fallen to about 112. So I can still write a covered call on Chevron and make about $1.70. I can do this in a short window, and I probably will. But on the other hand, I bought Microsoft at 93 and it's now trading at 87. So I find myself in a spot where I have to come up with a plan for Microsoft. And that might not be writing covered calls. Really, depending on where your purchase price for that stock is, you might be able to write a covered call and be profitable. Now, I've done multiple videos on writing a deep in the money covered call. And deep in the money covered calls are perfect for this volatile market. Hey, look, you own the stock, you sell that deep in the money covered call, you get that downside protection, and you get a little bit of premium. Look, if that interests you, I want you to go to my channel, type deep in the money covered call, and watch those videos. Because as the stock market falls, and if we believe the market's going to go higher, we're going to sell that deep in the money covered call, we're going to collect that downside protection, and then as the stock goes higher, we have a little bit of time value, which gives us our premium. A lot of times, those investments don't give us the 3 and 4 and 5% premium. But hey, in a falling stock market, call options are not priced where we're printing that money, right? People buy call options when they think the stock's going to go higher. And in a falling stock market, nobody's buying call options. So writing a deep in the money covered call on the shares you own might be something you'll want to do. Now, if you have some cash on the side, you might want to sell a cash secured put. And for me, this is one that I've already done a couple times. Look, you have the cash, it's sitting there, you'd like to buy a stock cheaper, but you'd like to get paid for that as well. And this is what you do. You sell that cash secured put, setting the money aside, picking the strike price you want to buy the stock at, and for the time you're going to give somebody that ability to assign you their shares. Well, That's a cash secured put, and I do it many times. Here's the deal. I'm going to show you a Facebook trade for which I did a cash secured put on, collecting premium. Cash secured put is an option if you want to own the shares cheaper, collect a little bit of premium during this volatile stock market time. Yeah, we can sit on our hands. That's the next one. And I say yikes because I hate doing nothing. See, I am a very proactive cat during these times. I never want to sit on my hands. I've told you the story when oil crashed and I held all those oil stocks. I did nothing and it just drove me into the ground. And I'm still licking my wounds from that. Hell, I still own Conoco with a strike price of 70 and I've held it the whole way. Look, I don't want to sit on my hands, but sometimes you have to. You have to wait out these very volatile times and see if you can get a couple green days. That might be the best thing to do. But hey, that is definitely a judgment call on your part. I don't like sitting on my hands. Sometimes you have to. Now, another one is writing a covered call. Right now I have Bristol Myers. And look, I purchased Bristol Myers at about 65. The stock has fallen to 62. Now, I feel comfortable that Bristol Myers will not get to 65 anytime soon. So what I might do with Bristol Myers, in this case, is write a covered call with caution. Now, what does that mean? That means my purchase price is 65. The current shares are 62. Well, I might write a 30-day covered call near my strike, near my purchase price of 65, collect the premium, and as Bristol finds itself back to 65, let's hope, the stock might go above my strike price. And guess what? If my shares are taken away, I would lose money, right? If I write a covered call that's below my purchase price, I'm going to lose money. So what I'm going to do is I'm going to take advantage of writing a covered call, but what I'm going to do is I'm going to use an exit strategy if it pokes its head above 65, goes a little bit higher. Chances are I'll buy it back, adding to my cost basis. But because Bristol has moved from 62 to 65, chances are call options are going to be good. The stock's moving higher. I'll be able to write the next covered call. Chances are I will cover my cost basis add and we can look to make money. Again, you can write a covered call with caution. With caution. Have to have your financial education, man. You have to have experience. Now, dollar cost averaging. Now, this has nothing to do with premium, but it is something that I have done recently. Remember I told you I bought Sands? Well, I wrote a couple calls on Sands and I ended up buying them back. Sands has since fallen just like the rest of the market, and I find myself really underwater. But I feel comfortable with Sands, and I know Sands is going to come back. A lot of good news with Sands. So what I did was, as it was down here at 69, 68, I bought some more shares. So now I lower my cost basis so I can now look to write a covered call to get me out of a negative position. Now, I hope the market doesn't continue to fall because then I would be in a more negative position. But again, have a plan. Execute the plan. And right now with my plan with Sands is to dollar cost average. Every time it goes down a couple dollars, I'll buy 100 shares. Now, at some point, I'm just going to stop throwing good money after bad, and I'm just going to have to live with it. I feel strongly that Sands is going to rebound when the market rebounds. But with that said, that's my plan, and it may not be your plan. And hey, finally, this is a tough one. This is a tough one. Having a plan to pull the ripcord. Look, remember I talked about Conoco? Had I had my 15%, which I do now, my 15% pull the ripcord when a stock that I purchased falls 15%, I would have been out of that Conoco trade in the high 60s. I didn't, and I just watched it fall day after day. Sometimes you have to pull the ripcord. You just have to. And in my case, I don't think I have to do that with Sands, but I might have to do that with CVS because CVS is just not acting the way I want. And hey, it went from 74 to 64, and I don't know. CVS might find itself at 54. So at some point, I might have to pull the ripcord, lick my wounds, move on. Sometimes you have to bite the bullet, pull the ripcord, and look for a better day. I know that sounds cheesy, and I know it sucks to hear that, but I have to have that because for me, 2 years ago when oil fell from $100 a barrel to $27 a barrel, I had so many oil stocks, man, my portfolio was crashing, and I sat on my hands and did nothing. Had I sold all my oil stocks, 15% less, man, I'd have been sitting in such a better situation, both with my portfolio and my emotions. So for me, I have that pull the ripcord percentage. And for me, that's 15%. Now, I know this video is getting long and I do apologize. Let's just blast through these charts real quick just to show you where I'm at. Maybe you'll learn something. I'm not sure. Let's talk about it. Well, the Dow has crashed. Look at this. All the way from about 2,700. Look at this thing. It is now testing support. The question is it going to bounce off this support and rally higher? If it does, chances are it'll find itself back up to about 25,000 and make nice with the entire world, right? We would love that if the market would move 2,000 points. But hey, look, at this point, I'm not sure. So I cannot be in the hope and pray business, right? I need to be active and I need to have a plan. So let's talk about 3 stocks for which I have a plan. Now, Whirlpool is one that I've told you I love playing because I know the range Whirlpool plays in and I feel comfortable with it. Problem is, Whirlpool has fallen below that range and now we're in new waters. New waters for me. So in this case, if you remember, I put in a cash secured put at about $165 and I got paid $3. So my cost basis is $162 if I use that premium for a cost basis reduction. I usually don't because I spend that money and I just take the shares at what I get assigned at. Well, in this case, I'm probably going to use that for a cost basis reduction because look where we're at now. Whirlpool has fallen to $152 and it seems to be falling every single day. Now, in the case of Whirlpool, it pays a $1.10 dividend. So if I find myself holding this stock, I'm going to collect a juicy dividend. And quite frankly, I've held Whirlpool for over a year when I was playing it. So I feel confident that Whirlpool will find itself back up above my strike price and I'm going to be able to write covered calls on it. Now, Facebook has had some horrible news and I don't really know if it's going to recover from this. Actually, I do know it's going to recover. In my opinion, Facebook's going to recover. When this news came out, what's the first thing I did that night when I got home? I started scrolling my Facebook timeline. Look, this is going to be a big deal in the news. Facebook is probably going to find itself in court. But I think at the end of the day, Wall Street looks at Facebook and understands that it is pretty much the only game in town for social media. And they're growing their revenues 40% year over year. If Facebook falls down to my cash secured price of $155, this stock is going to be trading at about 15 to 18 times earnings. And Wall Street is going to consider that growth, that revenue growth and profits as being cheap. Chances are they'll buy it up before it gets to 155. And this stock might, if the markets go higher, turn higher. My cash secured put at 155, for which I got $2, probably be able to buy that back cheaper, and then we will look to fight another day. In this case, though, look at Facebook. Facebook has just tumbled off, man. This is very similar to Win, when Win fell from 200 all the way down to 161. Well, Win has since recovered. I think Facebook could recover here too. So I'm going to be watching it, but right now I have a cash secured put, 155, and it's a 3-week window, so this is going to expire the first week of April. Now, I want to leave you on a good note, man. It sounds like I'm just getting kicked in the nads, and I actually am. But I do have some stocks that I've been making some money on, and Chevron is one of them. See, for me, Chevron trades in this nice range, and even in these bad markets, people love Chevron. Well, I love Chevron too. I've owned it for years, and for me, I find that Chevron, every time it gets this nice little dip, Wall Street buys it and they rally it up. You can see every time it falls, it then rallies up. Well, if you trade Chevron, you know you can get a $3 out of the money strike. You might be able to get about $1.75 for it. So you're able to collect that 3, 4, and 5% on Chevron in a short window. Now, Chevron pays a $1.14 dividend as well. So if I get stuck holding Chevron, they pay me a juicy dividend. Look, Chevron's one of the greatest oil companies in the world, and the stock has shown to be a winner, even with oil fluctuating up and down. So I buy Chevron. I play those little out of the money strikes, getting about $1.50. And for me, it's worked out, and I love holding Chevron. Now, in this case, I have a 117. I got paid $1.75 for it. Heck, when it fell the other day, I almost bought it back for under $1, figuring with this market tanking, I'll just take that off the board. I don't know where Chevron's going to go. I'll look to possibly hold it for another covered call. But I didn't. It's still on the books. We'll have to see where it goes. But right now, Chevron is a positive trade for me, and I'm going to keep playing it. Now, hey, look, before I let you go, a lot of you cats are emailing me. You're in trouble. Look, stay positive, have a plan, get your financial education, and look for a better day. That's all I can say. I don't have a crystal ball, and I find myself in the same situations you do. The only thing I can tell you is I've had over 350 trades over the past 2 years. So I have been there, done that. But here's the deal. You can too. So you too can have the confidence to work through these times of volatile markets. Look, I'm pulling for you, and I do wish you the best in trading. I hope you enjoyed this video, and if you did, bang that like button. And hey, until next time, I hope all your covered calls are profitable.
All I see is signs, all I see is